Super bubbles can really wipe you out, like 1929 did. And that's where we are now.
Do you want to know the stock market and the economy? Do you want to avoid losing money and make fortune by avoiding market bubbles? Then watch this video until the end, because we will tell you about Jeremy Grantham, the legendary investor who is betting that we're headed for another crash that will change our generation. So, who was Jeremy Grantham? And why should we listen to him? Jeremy Grantham is a British investor who co-founded GMO LLC, a Boston-based asset management firm with over $65 billion in assets under management as of December 2020. He is also a philanthropist who has donated hundreds of millions of dollars to various causes related to climate change. Grantham is known for his contrarian and long-term approach to investing. He follows a philosophy called reversion to the mean, which means that he believes that all asset classes and markets will eventually return to their historical average. He uses historical data and analysis to identify when markets are overvalued or undervalued, and then takes position accordingly. He has been very successful, as he has avoided some of the biggest market crashes in the history by spotting the signs of bubbles and getting out before they burst. For example, he avoided investing in Japanese equities and real estate in the late 1980s during the peak of the Japanese asset price bubble, which collapsed in early 1990s and resulted in a lost decade for Japan's economy. He also avoided technology stock during the internet bubble for the late 1990s, which burst in 2000 and wiped out trillions of dollars of market value. He limited his exposure to the housing bubble in the mid-2000s, which burst in 2007 and triggered the global financial crisis. He has also been very vocal about his views on the market and the economy, writing newsletters and giving interviews where he shares his insights and predictions. He has warned about the dangers of climate change and environmental degradation for years, arguing that they pose existential threats to humanities and civilization. He's also been critical of various governmental responses to the global financial crisis from 2007 and 2010, saying that they have created moral hazards, increasing inequities, and delayed necessary reforms. So, what does he think about the current state of the market and the economy? Well, he thinks we are in a massive bubble bound to pop sooner or later. He thinks that this is one of the most extreme bubbles he has ever seen in his career. He bases his opinion on several indicators to measure market valuations and sentiments. One is the Shiller PE ratio, the cyclically adjusted price to earnings or CAPE ratio. This ratio compares the current price of a stock or an index with its average earnings over the past 10 years. Adjusted for inflation, it means to smooth out short-term fluctuation in earnings and capture long-term trends. The higher the ratio, the more expensive the stock or index is relative to its earning history. The lower the ratio, the cheaper it is. The historical average of this ratio for the S&P 500 index is around 17. As of August 2021, it was around 38, meaning it was more than twice as high as this historical average. This implies that stocks are extremely overvalued by this measure. Another indicator that Grantham looks at is the Buffett indicator, which compares the total market capitalization of all publicly traded companies in the US with the US's gross domestic product, GDP. This ratio measures how big the stock market is relative to the size of the economy. It is named after Warren Buffett, who once said that it is probably the best single measure of where valuation stands at any given moment. The higher the ratio, the more expensive the stock market is relative to the economy. The lower the ratio, the cheaper it is. The historical average of this ratio for the US is around 100%. As of August 2021, it was around 200%, twice as high as its historical average. This implies that the stock market is extremely overvalued by this measure. Grantham also looks at other indicators such as the price-to-sales ratio, the price-to-book ratio, the dividend yield, and the profit margin to assess market valuations and sentiment, to gauge market psychology and mood. He also considers qualitative factors such as investors' behaviors, media coverage, and public opinion. He says all these indicators point to the same conclusion, that we are in a bubble detached from reality and unsustainable. He says this bubble has been fueled by cheap money, excessive speculations, and irrational exuberance. He blames the Federal Reserve and the other central bank for keeping interest rates artificially low and pumping trillions of dollars into the financial system through quantitative easing and other stimulus measures. He says that these policies have created a moral hazard where investors feel they can take on more risk and leverage without facing any consequences because they expect the central banks to bail them out if things go wrong. He also blames the rise of the passive investing, where investors buy index funds and exchange-traded funds, ETFs, that tracks the performance of a basket of stocks or bonds without paying much attention to their underlying fundamentals or valuations. He says this has created a herd mentality where investors unthinkingly follow the market trends and momentum without doing any research or analysis. He says this has led to a concentration of capital in a few large companies that dominate the indexes, such as Apple, Microsoft, Amazon, Google, and Facebook. He also blames the emergence of new forms of speculation, such as cryptocurrencies, meme stocks, SPACs, special purpose acquisition companies, NFTs, non-fungible tokens, and Robinhood traders. He says these are signs of speculative frenzy, where investors chase after quick profits and high returns without caring about the rest of fundamentals. He says these are signs of a market mania, where investors lose touch with reality and rationality. He says that there are several potential triggers for a crash that could be devastating for investors and the economy. These triggers include a change of monetary policy by the Federal Reserve or other central banks, a surge in inflation or deflation, a geopolitical shock or natural disaster, a technical glitch or cyber attack, and a loss of confidence or a change in sentiment. If any of these events occurs, they could create uncertainty, panic, and chaos in the market, leading to a mass exodus. For example, a change in monetary policy by the Federal Reserve or other central banks could affect the interest rate, the money supply, and the exchange rate, which could impact assets prices, the borrowing costs, and the trade flows. A surge in inflation or deflation could erode the purchasing power of consumers and businesses and distort the relative prices of goods and services. We hope you found this video helpful and informative. If you did, please hit the like button and share it with your friends and family. And if you want to see more videos like this, please subscribe to our channel and hit the notification bell to get notified with new uploads. Thank you for watching, and we will see you in the next video.